And we're live. Welcome, everybody. My name is Caroline. This is Ingryd. And below me, I have Marlon. I feel like we're the Brady Bunch right now. We are going to be underwriting a deal that Ingryd has. So, Ingryd, I'm going to give you the floor.
Well, we're not underwriting a creative deal. What we're doing is reviewing the entry fee calculator. So thanks to my good friends like you, Caroline, and Marlon, it's gotten some solicitation. I don't know, some spotlight.
Exposure.
I blew it up on the Tuesday podcast.
Yeah,
and everyone's
exposure,
like,
spotlight. I also talk about it because people will send me deals. And then I literally had somebody text me yesterday. They're like, hey, I have a deal. Do you buy in? Like, it was like a small mining town here in Arizona. And I was like, well, what's the cash flow? Because, if it's $1,000, then why wouldn't I look at it? He's like, I don't know. We haven't looked at the rents yet. And I was like, I want everybody to think when they are doing a creative finance deal, think about cash flow. That should be like right up there and highest priority because people buy creative finance deals either for their primary residence because they are a non-qualifying buyer, like a non-banking qualifying buyer, or you're an investor who wants it for cash flow. Primarily, it all depends, but I don't want to complicate things. Newer investors like myself, we want for cash flow. In the future, depending on the property, sometimes you want it more for depreciation than you want for cash flow, but for the purposes of today, it's for cash flow. So, all right. I don't know how to use this thing. Oh, present. My friends.
That's all I would click present, and then I would do
share screen
on a tab. I would do a tab, or you can do your whole screen if you want.
Wait, so why does Ingryd get to hang out inside like the studio? I feel like I'm a guest. I don't get all the cool features.
I don't have that on yours.
I don't like being on this side of it. I don't know what's going on. I can't see the comments. I can't see anything.
Oh no. Should we start again?
No, it's all good. I'll just make do. I'll just be a peasant on this side.
Well, I just found out too that apparently my settings aren't right because it's asking me for all these privacy things. Oh. Like, how do I click the lock to make changes?
I'm clicking, that's gonna be because you're on your different computer right now.
So, oh man, I really do want to get back there. I want to play with like the camera settings. But anyhow, while we're waiting for that to get pulled up and set up, I want to explain the importance of really understanding getting creative deals, being able to buy any sort of real estate or just investing your money in general. It's important that you understand the reason why, knowing what an entry cost is and an entry fee is. And sometimes I think this gets lost on a lot of the newer investors. They start looking at properties and they are able to say, well, look, Marlon, like it'll look at how much it'll rent for, right? It's already got month-to-month tenants. They're renting at $1,500 per month, $1,000 per month, $2,500 per month, whatever the number is. And I want people to think about it in very basic terms. See, what started to make real estate make sense to me was when I started to look at it from this vantage point of, imagine I was at a store and I'm the salesman in the store, and I'm saying, hey, Caroline, I've got this box. I'm going to sell you this magic box. And this magic box is going to print you money every single month. Every month, this magic box is going to print you a $100 bill. Every single month, without fail, it'll just print it out. You keep that money. Now, Caroline, I want to sell you this box because it's so valuable. And are you interested in buying it? You might say, well, duh.
Absolutely. I'd love an extra $100 a month.
It just prints money every month. Yeah. Right. But if I said, Caroline, all right, this box is going to cost you $1 million, you might say, it's only printing $100 though a month. Right. I might not be as interested. But if I say, hey, Caroline, this box is only going to cost you $10, you might be like, oh my God, like, how many of these can I buy? Now, I might also say something like, Caroline, I'm going to sell it to you for $1 million, but you only need to pay me $10 per month. Right. So although the overall cost is $1 million, you're only paying me $10 per month. It prints $100 per month. Every month, you're still netting $90. See, we want to start understanding why the entry fee matters so much, because sometimes you see us talk about buying $500, $400, $700 million property. And it's not that we're paying $1 million all today to buy this property that's going to spit out $1,000 per month. It might be that, hey, although I'm buying it for $1 million, my entry fee determines that I really only need to come up with $80 a month, $100 a month, $1,000 a month, whatever the case may be.
Right. Or in this case, for entry fee, it's your upfront cost.
Mm-hmm.
So Marlon, I think, did a good job of describing some dynamics and levers that are presented during an offer. So $1 million, the cost of the asset, how much it returns to you, $100 a month. What would that cost you on a monthly basis as a result? $100. So all of those things are components of an equation. But one of the most important things to learn is, what do I need to bring to the table at the beginning? And when you hear a lot of investors talk about cash on cash return, they're actually talking about, what am I going to have to invest in liquid, whether it's mine or not? It could be somebody else's money. And you may also hear people say, well, that's an infinite return, for sure. But it still needs to be a formula that then I can present to that private money lender that says, hey, I'm going to go buy this deal. It's going to cost me $40,000. Do you have that $40,000? I'm going to show you how you'll get a return. Because then in that scenario, it's an infinite return for me. I'm not investing any of my money. But okay, so that's a lot of words, a lot of concepts. Caroline, I put the spreadsheet. I cannot present it.
Oh, there
That's
we go.
my girl. Hey. Okay. So when I'm in the spreadsheet, I won't be able to see you guys, but I would love your feedback. So our goal
What I'd
today.
like you to do before you get in there, if you can go on the top right, and if you could zoom in a little bit, so the green column,
I'll just click like Control plus,
is as zoomed in as possible. It's just really small.
Okay. I thought I was the one with like the old eyes here.
Well, one more. Actually, no, that's good. That's good.
There we go. Now people can
see what's
good? Going on. Yep, you can read this.
So when I'm in the screen, I actually can't see you guys.
That's okay. We got it here.
Okay, right on. Okay, so our goal for today is to review these 7 entry fees and how they all put together into a total entry fee. How this spreadsheet can actually help you identify whether it's a deal or not. It's really broken up into 3. So you have these first sets of greens here where you'll give your total. You have the next set of grays where you won't touch, but it'll give you, hey, what would you typically pay a private money lender on a monthly basis for getting the privilege to borrow that total entry fee? Mm-hmm. And then the last section here is all the stuff that helps you identify whether or not it's a cash flowing asset. Okay. Now, at the bottom, I guess 4 sections. At the bottom is where you'll see the big picture numbers. So what's your monthly cash flow as a result? And then NOI stands for net operating income. In fact, I should update that so that people aren't guessing what an NOI is.
Yeah, we don't know all of the acronyms here. Mm-hmm. Before we go any further as well, Ingryd, because I know you can get this from your link tree on your Instagram channel. And if you guys look at us here, like this is my Instagram. If you look at Ingryd's, that's her Instagram. Marlon has his Instagram. On the profile, it has the link that you guys can go to. Now, right now, I see at the very top in teal, it says go to file, make a copy. I know you said it there, but can you just give me an example of how to make the copy? Because sometimes I'm technologically illiterate, just so we have everything down. Sure. And then which fields are we supposed to fill in on here? Are we allowed to touch everything, or will it mess up our formula? Give me a walkthrough like I'm brand new.
Sure. Well, this version you technically can't touch. I think I fixed the settings where if you wanted to, you couldn't edit it. But what you can do when you're first here, go to File, Download into Excel, and then save it on your own Google Drive, your own desktop version. On occasion, I am updating this calculator, so I would just remind yourself to come take a look at it. I did a few changes just recently, nothing very significant. If you had like a slightly older version, you're fine. But just so that we could clarify a couple of things. Like, for example, I added another line for other expenses. I also put my buy box because people ask me after they use this, well, what's your buy box? I'm like, okay, this is what I want. So send them over. And you can send me deals through my Instagram messages. I'm pretty good at responding to those. So does that help?
Yes. And then so once we do, and you did say download. Can you go over to file really quickly? Just click on
Go
file.
to file.
And then if you look 1, 2, 3, 4 down, it says make a copy. You guys can make a copy and it'll open it up in a new window as well. So that works and you guys can have access to it. All right.
There you go.
Yeah.
Right on. Okay.
So now how do we put in I guess take it away. How do we put in our information if we want to underwrite and make sure it is a good deal?
Yeah. So only touch the cells that are in green to fill in. But let's work through each one. Caroline, do you happen to have a deal that you want to look at, or?
Yeah, you know what? We can talk about the one we've been texting on. I need to call him after the Zoom.
Right on. So let's do that one. All right.
Okay.
Caroline. So cash to seller. This means that's the very first one out of 7. That means what dollars am I giving the seller at the time we close?
Seller. Yeah. So to the seller, it's going to be $40,000 to the seller.
Right on. So 40,000.
Okay. There are no arrears. So
can we explain real quick that when we talk about the cash to seller as a down payment, what that means? Like, like when we say like we're giving cash to the seller, like what are we talking about? Like, so I'm only buying the house at $40,000.
So do you mean the purchase price and the down payment?
Right. So like the cash to seller, I just want to clarify that when we talk about the cash to seller, that sometimes that can be them cashing out and we're just putting cash in their hand to walk away if we're taking over a mortgage entirely. And sometimes if they have equity and we're doing a hybrid deal, that sometimes this cash to seller is going towards their equity portion as a down payment on their equity. So there still might be more money that we owe them. So whenever we're looking at cash to seller, just clarifying and understanding that for anyone that's brand new, this is the money that we're giving somebody at the close of escrow so that we can commensurate and move forward with the deal.
And close of escrow means when we actually close the deal with the seller and either the deed is being transferred or we're putting like something like a land contract together. So something is being recorded and your transaction portion is done. Yep. So all good things. I think you did a good job explaining. I don't know if we need to go further than that, but
you hit the nail on the head. It's an owner finance deal. So just so you all are aware, the total entry, the cost of the property is going to be $589,900 with the down payment of $40,000, which will bring our total balance to $508,900.
So not 589, 548. Right? Or 549?
Correct. 548,900.
Yeah. Okay. Just making sure those numbers make sense. Okay.
Yeah. It's not behind because they own it free and clear. So there is nothing to that. Actually, Ingryd, I was going to see if tomorrow you want to go over to Glendale to look at a house that's in foreclosure. It's going to be auctioned off next month.
I'll be in Avondale tomorrow, so for sure. So from 11 to 2 tomorrow, we're having an event with my cousin who is a big marketer in the Hispanic community, and they're doing an event to I can't recall all the details. They're having an event, and so our goal is to reach out to potential buyers because people who have what we call an unqualified buyer. They'll have a big down payment. They can't qualify with the bank because maybe they're an ITIN holder, meaning they don't have a social security number. They have the TIN number that allows them to work in the United States. It also allows them to buy property. So our goal is to talk to as many potential buyers tomorrow and get their names so that when we come across these really cool seller finance deals or these really cool sub-2 deals that they can buy them and we can help them with that. So anyway, back to the arrears.
Mm-hmm. So arrears, that's typically when it has money owed that they haven't paid. So there's no arrears. The next, man, I do feel like I'm getting older and my eyes are getting worse. Cost to the lead, wholesale fees and commissions. So we were talking about that, Ingryd. Are we saying $5,000 or $10,000 for the assignment?
So here's what I like to do. I like to put best case scenario down. Mm-hmm. Then after we look at the cash flow, then we say, this cost of acquisition is too much. And that's the more negotiable number. Could we put that number down? So let's shoot for the fences, right? Let's see if we can hit a home run. And if we realize it's got to be like a double or a triple, and yes, I do sports analogies. I played softball forever. Then we can back away a little bit. So we'll just go ahead and put 10,000 and then we'll work our way back.
All right. So you guys all know, both of these deals are from agent outreach. So it's really free 99 except for your expenses. Okay. The next one is, how much does the closing attorney / title company? So I'd say like 1% of closing cost. What do you like to go over and say?
1% of the purchase price. So
Excuse me.
In the state of Arizona, 1% is a pretty good number to go after from like a document creation and all that your title company will do. If you're using a creative finance TC, like we use, the creative tc.io. That is one of our sub 2 guys who has a TC company. I use them frequently. They make my life easier, but I would also add their costs on here. And oftentimes it's anywhere from like $850 to $2,500, depending on what kind of transaction I'm doing with them. So if it's not that arrangement, you have an in-house TC, or you have, you know how to do your paperwork, then generally in Arizona, it's 1%. If you're an attorney state, I would say 2%.
Okay.
So because this is what, 548 purchase price, I'll just say 5,500 and like round up a little.
Okay.
All right. So the next entry fee is your rehab, reno, cleanup, furnishing. So this one's, sometimes you could actually break this up into 2 different categories, which is like the house to fix up for renters. That hopefully that number is more reasonable to the state of the house, but Airbnbs, those tend to have a much higher entry from like a furnishing perspective. My guiding principle on those is generally $5,000 to $7,000 a room to furnish. So what do we have here on this property?
So the main thing, because I walked it, it needs, I think, again, I have not done a lot of stuff, but the pool needs to be resurfaced. I think we talked probably like, I think we're going to be under $15,000 altogether. I like to be conservative. It just has like little finishing touches. It is livable, but it's not in perfect condition. So I would say 15 just to be over conservative.
Okay. And then were you going to say something, Marlon?
He's muted.
No.
Oh. Okay. Because I can't see you. So if I slightly hear you, I'll call you. So, all right. And then we have holding payments. So what's our runway? That means, how long do we think we're going to keep the property before we have tenants in there or ready for going live on Airbnb or any of that? What number do we think we have there?
Well, I know the exit strategy we were talking about would be
sober living
house. So I have not done one of those. I mean, the main thing I think would be maybe a month, if that. I would
say a good rule of thumb for runway, even for normal rentals, I would always put at least 2. And then it just always depends from there, right? If you have actual good big rehab renovations that you have to do, then you might want to do, well, not might, you will definitely need to go out for however long you think that's going to take. But good rule of thumb is just at least 2 months. Marlon and I are getting into another deal. And how many months did we put on that runway?
We put 2 months in on that runway.
Okay. And for us, we already have certain folks who have displayed some interest in that property. So we don't even feel like it's going to take a whole month. But again, we want to be conservative and have reserves, which is something I feel like we don't talk a whole lot about in our creative finance world. You should build up some level of reserves. Things do not always work out as perfectly as we hope they do. And hope is not a strategy.
Okay. So when you would include this, would you do so the monthly payment for the property, your private money, all of that?
Yes.
Okay. So right now, if you do, so the monthly payments on this, we're going to be $22.53.28 a month. So I'll multiply that by 2. I'm at $45.06.56. I wrote down the private money that you'd borrow. I did $60,000 at 10%. Do you think I'm undershooting it? Do you think I'm overshooting it? Because our monthly payment then would be $500.
Well, again, always like be conservative, and then we can pull back. So what I saw before I put the 5,400, so I'll go back to 0. I saw that our interest payments to our private money lenders were already around, 4 to 600, or 470 to 600. So if the PI is around 22, I'm already rounding up. So it's more like 2,800 or so. So 5,600. I think we're okay with like around 5,600.
Okay.
Okay. And so then we have marketing fees. Do we need to have any photography taken to solicit this? Do we need to pay any sort of agency to go get the type of people that will live here? Do you have like any Airbnb fees or anything like that? Do you think that we would, that's what would go into this line item, or anything really nuanced that wouldn't typically be a part of this breakdown? So do we have anything there?
Like being conservative, I would say maybe like $200, $300 just to cover that.
For like some photography,
photos,
maybe.
yeah.
Yeah. Okay, cool.
Your marketing part of your department.
Yeah. All right. So we have private money at around 635. I say 10% is very typical of these types of payouts. However, with the market being as volatile as it is, I think 8% is also becoming a lot more popular than typical, because people really are looking for that security of that payout. And again, when you're a private money lender trying to lend on these types of deals, generally speaking, you want to make sure that your money is secured by a deed of trust and a promissory note. We don't have time to go through all of those things, but just something to call out if you're if you're considering giving people money, like myself, Marlon, or Caroline. Know that we know how to do things well, and we would secure your money through a deed of trust and a promissory note.
Ingrid, could I add something there?
Absolutely. I was just going to ask.
Yeah, so because right before we actually got on here, I was talking to one of my lenders, and we were just catching up. My lenders I have relationships with all of them. So sometimes we're just like talking life, and sometimes we're talking business. And this particular lender, I was asking her what's been going on with the market, because she mentioned she's in the middle of her own personal project. She's renovating one of the downstairs units in a home she owns out in New York, and she's turning it into an apartment. And she's been using the cash on hand to do so. And she expressed to me that, like, hey, I'm actually running out of cash on hand, and I'm getting ready to HELOC one of my properties. And I asked her, like, what's going on with your portfolio? And she's like, oh my gosh, don't even get me started on that, because I don't know how many of our listeners and our viewers have money in the markets, whether it's 401k, 403b, some sort of retirement plan. Unfortunately, right now, a lot of people are seeing that the monies that they've had in the market, it's peaking out, right? And it's actually starting to even move in a little bit of an opposite direction. So over the last couple of months, they've been happy because it's been going up and up and up and up. And, there's nothing to think about when things are going up and up and up. But now that we're starting to begin to see it peak out and actually start to come back down in a little bit of a different direction, I want to let people know that they probably already know this, but if they don't, you're able to actually take that money from your retirement account and put it into what we call a self-directed IRA. Right? This is something that you can do. You can put it into a self-directed IRA, and you can use that money to invest in property. And now you might be wondering, like, well, why would I invest in property if the market's going down and down and down? And it's because of cash flow. See, it doesn't matter if the market's going up, down, or sideways. We get cash flow regardless of what the market is doing. So property is something that we can begin to look at. And I mean, we're not going to talk about it in the scope of this video, but like one of my favorite things about property is depreciation, right? Because you get depreciation no matter what's going on, whether the market's going up, down, or sideways. We get a thing called depreciation. So I just want to remind people that as they're thinking about their next steps in 2023, as they're becoming more financially aware and more fiscally responsible, to start to acknowledge that you have more options available to you, and you want to continue to put yourself in a place where you're looking at, okay, how do I pivot? What's the best thing to do right now? Where can my money be protected? Like Ingrid said, having a first deed of trust, being in a position where a property you're stepping into has good cash flow, things of that nature. If you ever have a conversation about that or questions about it, reach out to Ingrid, reach out to Caroline, reach out to myself, and get your questions answered. Don't sit down on the sideline and not get your questions answered.
One other product that can be used, because self-directed IRAs, if you do invest into any properties that have debt arrangements already, so like a loan product against that asset, you end up taking what's called a UBIT tax ratio when you profit from that asset. And so it's an additional tax when you're using IRA products. Now, I'm not a CPA, I'm not an IRA expert, but I did exactly what Marlon is saying. I was really concerned with where my 401k was going. I had some qualifying ability to move my 401k. So I actually moved it into what's called an EQRP plan. It's a 401k trust plan. And because of that, if I do invest into any deals like the one we're seeing right now, where there are already debt instruments in place, I don't have to pay that UBIT tax. So something to think about, especially if you're doing any sort of syndication investing where there's usually a very big debt instrument in place. Or loan, right? So just a thought. But I'm also happy to answer those questions as I learn about it myself, because I am trying to put that aside and invest with Marlon and invest with Caroline, because I trust them. I know that they're really good at creative finance, and help them build my retirement plan. So, all right.
And just before we move on, anytime I hear a word and I'm just like, people might not know what that is. Can you just quickly define debt instrument? Like, what is a debt instrument? Like, what does that mean when you say that? Because people are just not in it. Oh, yeah, debt instruments. Yeah, of course. You don't want those in place. What's a debt
when
instrument?
there's a loan and the loan's involved. So somebody took out a mortgage, somebody took out some sort of commercial loan, especially when you're talking about multifamily. They've taken out a commercial loan. That loan is in place. It's a ratio of, so sometimes you'll have like 75% is a commercial loan. The other 25% has been raised with people with IRAs and things like that. And so now you're talking about and I'm not an expert in this space, but the UBIT tax looks at the fact that 75% of that deal has a loan. So when you make a profit, let's say your profit is 100 grand, I have no idea. That 75% ratio is taken into consideration with the taxes that you owe. It's an additional tax that most people don't talk about, that I don't really have a lot of expertise, but I do try to avoid those types of taxes. And that's why I went with what's called a EQRP plan. And I don't remember what that's called actually, what the EQRP stands for.
So essentially, if somebody is essentially thinking about lending and they find that they may be in a second or third or fourth position on the property, on the deal, they should be interested in reaching out to you and just having a conversation, getting pointed in the right direction of potential some other options. But if they're going to be in a first position lien, in other words, they're going to be lending on a property that doesn't have any pre-existing debt, then they don't necessarily have anything to worry about.
That is correct.
Okay, awesome. I just want to make sure that the people, like the ones that are like, oh, shoot, okay, that's me. That's my position. I should raise my hand, So if you're going to be a lender and you're going to be in a second position, a third position, a fourth position, that means there's already somebody else lending, whether it's Bank of America or Billy Joe from down the street. They're lending before you and they have another lien on the property before your lien. Then you want to potentially talk to Ingryd, reach out to her, find out what she knows.
All right. So that was, now I went and Googled it. It's an enhanced qualified retirement plan. Oh. Sorry, I could hear the ice.
Yeah.
The enhanced qualified retirement plan. And like I said, it's like it is a 401k trust, and it actually gives you the checkbook. So you don't have to pay a custodian. So it's actually cheaper than having an IRA plan. So just a thought. Let's move on from that. So as you can see, this deal right now has $76,300 as our entry fee. So I can be really confident to go to someone like Caroline or Marlon, who I know are investors. And I'm like, hey, you got $76,300. and 50 cents. No, I'm just kidding. To invest into this property. And what's the very next question they're going to ask me if they're creative finance investors?
How much am I going to make on this? What is my return?
What's the cash flow? Right? They're creative finance investors. I was hoping that maybe I gave that away, but
nugget earlier, yeah.
Yeah. So if I was to borrow this from somebody who had something like a EQRP plan or an IRA, this is what I would be asking them for. And then hopefully these returns are beating what those plans have. So they're making the spread, meaning what their IRA would give them had they left it versus what this return would be. And those plans, again, I'm not a CPA or a stock person. Those are usually paying out in like the lower single digit interest rates. And so we always feel pretty good about what we can offer here. All right. So because this has a specialty expectation on rents, I already know that this wouldn't cash flow traditionally, but the reason why anyways, my advice would be always do your due diligence and figure out your cash flow based on market rents. In this scenario, like your normal long-term rents, meaning your typical, I'm going to go rent it for a year or two. If I'm a renter, what does that rent look like? We're not going to do that in this scenario because I already know this is not a cash flowing asset for that. But we have a very special kind of buyer that we know wants to be able to rent this property for its best use, its highest and best use, which is a sober living facility. So before that, his average is around $6,000 for a property that has these very specific requirements. It has to have at least 4 bedrooms with an opportunity to maybe put a 5th. And it needs to have 2 to 3 bathrooms, which we know this property fits. So I'm going to put 6,000 here for monthly cash or monthly rent because I already know that that's his average. So we're going to go from there. Okay. So what would be the monthly equity to seller on for this seller finance deal? Would we have anything else, or is it just making a payment to the seller?
It would just be making that payment to the seller each month. So it'd be $22.53.28 a month.
$22.53.28 a month. And then what does that entail for this example? Is it the principal and interest?
That's the principal and interest. So the interest on that, like for the first month, was it's $1696.33, and then that principal is $556.95.
Okay, fantastic. Okay, so that's what I'm going to put in there. Okay, usually we have like a PITI for like a sub 2 and things like that. So we'll just keep that in the back of your head, which we won't have in this scenario. Let's see here. So now we have, what's that private money lender expense? I'm going to say we're fantastic. We're able to tell people why they should go in on this deal at 8%, given where things are with the market. Are we all good with that?
Yeah. So 508.67.
Okay. And then do we have a PITI?
We do not. I did not have taxes and insurance on this yet.
Okay, cool. We have another line item for that. Okay. If you want to kind of work that out. Now for a monthly war chest, usually for like a class, I don't know if I want to define class B, but class B properties, right? They're really good neighborhoods, strong commerce, strong economics in the area, has still room to improve, like, good economics. So strong, maybe middle class property area. That's what this property is for, right? Like, or that's the economics of this property where it's located.
Yeah, it's in a really good area. It's in a great area. And just so for everybody, if you guys want to figure out how you can kind of underwrite it, I just went to bankrate.com and threw our numbers in. So if I go off of the I mean, do you want me to pull the taxes for the city, Ingryd, and try and figure out what the taxes would be, or should I just go with the example that Bankrate's giving me?
So you know what? Our good friend Dustin Kircher just recently posted an Instagram where he was underwriting for cash flow using the existing tax rate, which is a good starting point. But if you buy at a higher purchase price, the city will likely adjust your taxes. So if we know what the percentage is of the taxes in that city, we should probably calculate them out so that we're closer to what we're actually going to get impacted on cash flow.
Okay, let me see if I can pull that up.
Okay. While she pulls that up, because she says it's in a really good neighborhood, normally I would call this class of neighborhood a class B. Just like when you're getting like your report card, are you getting an A, a B, a C, or a D, right? That kind of translates to the economics of where is this property located. Usually in a class B, I'm putting 10% of the rental income away for any expenses related to having to fix something in the property, to having to figure things out for vacancies, stashing some money away if something happens in the property that needs addressing right away, or if we need to just fix things in the house. So anywho, hopefully I explained that well enough. And this war chest is what we call, it's all inclusive. So you might hear the word CapEx, so capital expenditures. So you're starting to put money aside in case you have to do a big purchase. And so this should never, when you think about war chest, right, think there's like a lock and key on like a lockbox chest. I don't know. That's what I think about. That means you put this away, you don't touch it. And hey, maybe one day you sell the house and this baby has, gotten really big. There's so many other things you could do with this money, even when you're negotiating how you're going to sell the house. So anyway,
Ingryd, let me ask, if I buy a house like this and I own this property and I'm renting it out, and maybe 12 months from now the water heater goes, where am I paying for the water heater? Where am I getting the funds to pay for the water heater?
This reserve right here. And then plan B is plan B is, hey, Marlon, you and I are, we're partnering up on buying a house. If there's not enough in reserves, that means whatever equity partnership you have. So if we're 50-50 splits, or maybe we're 45-45-10 splits, that ratio is where you have to actually put money. Like if, let's say it's a $5,000 fix, you divide it by that ratio, and we all contribute based on our equity into the deal. I just heard Pace talk about this today, and it's actually called a cash call, meaning everyone who is a part of this part of that partnership, everyone has to be put in that money based on your percentages of partnership. So,
and could I mention something here?
No.
So when it comes to the war chest, what I want people to start thinking about is also, yes, it's going to be where any sort of reserves that are needed for renovations, needing for turning a unit, needing for painting a wall, needing for the unexpected oopsies that may occur along the ownership of this property. That's worst case scenario. Best case scenario, I also want you to think that this is the game of Monopoly. When you buy those little greenhouses on the Monopoly board and people are paying you rent, you're using that money. A part of your funds that you're collecting are going towards the acquisition of more property. So imagine I have 10 properties and the war chests are getting built up, and these are new build. I have great tenants. Things aren't getting destroyed. Things aren't getting annihilated. I'm able to then start to look at my war chest account as, how do I go out and continue to grow and build the kingdom? That's why we use this terminology of war chest, because the war chest was how the king was able to go and continue to expand on the empire. So this doesn't allow the king, it doesn't let the king slow down. It actually lets the king and the queens speed up the process of growing. So I want people to start really, because sometimes we think, well, it's a new house and nothing's going to be needing any sort of repair. It's got a new AC. They put a new roof on it 2 years ago. I don't need a war chest. Well, do you not want to expand your kingdom?
Guys, so I actually have a commitment. So we got to start getting closer to the end of this explanation. And thank you so much for that. The other thing I was going to mention real quick is if I'm going to ask private money lenders to invest in me, I also want to show them that I'm being responsible with their money and my money, our asset, and planning for what could be a bad experience. So, all right. So did you get a sense of what the tax and insurance might be for this one,
Yeah,
Caroline?
so I was looking on the monsoon. I
Mhm.
think we're probably it's the prelim for 2023 as it did the improvements on the property was at 321,000. Actually, let me go back. 2022 it said 239,200 and it had the
Mhm.
tax amount at 2,027. So I think purchasing it up around like where we are right around 550. I think we're probably going to be around 4,000, 4,500 for the year, maybe five. So I think all in with property taxes and insurance, we're probably going to be around $450 a month.
Okay. Now she's combining them, which is totally fine. So the reason these are called out separately in the spreadsheet is really to instigate your memory of, hey, I need to go do this, right? Being that this is a seller finance scenario, we can't cheat with all the PITI stuff that would already have been there if there was a mortgage in place. This one, we actually need to go and actually figure it out. So that's great. Now, does this property have an HOA?
No HOA.
All right. And then what do you think about utilities? As this is sober living, so actually we would have to pay the utilities.
I'm thinking it'd probably be up a little bit just because if you're going to have 4 bedrooms potentially converting into that 5th bedroom. And I know there's certain areas like the living room didn't have a ceiling light. So we were talking about like having lamps in there. I know just for where I live in a 2 bedroom right now, I guess like on average, based on my own living situation, during the in-season months, I'm right around $70 a month. I think for us to be safe, we should probably say like 150, maybe $200 a month.
Okay, I'm gonna say 400.
Oh,
And
okay.
here's why, because
You have a house.
I have a house that's pretty big. It's actually
Mhm.
bigger than this property, and I have 4 people that live here. So
Oh,
on the
perfect.
higher season, this could actually be higher, but we're gonna average it out for the year, not just during
Mhm.
like the high seasons. So that also means as we put money away for utilities, right? That we're preparing for those high seasons as well. So I would say on average, your utilities on the higher end is around 400. So, and utilities are electricity, water,
Well,
and then here,
I
sometimes
don't.
it's like trash and sewer.
Mhm.
I don't think it's a gas property, right?
I didn't see gas. That's what I was going to
Yeah.
say. I don't.
Yeah.
It's all
All right.
electric.
So based on those numbers, would you do this deal?
I right now, yeah, with 1,700.
Yes, man. Look at this cash on cash
Yeah.
return.
That is great. That is awesome cash flow. And then, yeah, anything over 25%, I should be, let me do my Tom Cruise. Oh my gosh, that's the best thing ever. Oprah. Oh, so yeah,
Yeah.
I'm in love with this cash flow and the cash on cash return. So yeah, I think it's a really
You
good
get
deal.
cash flow and you get cash flow and your money is safe with this deal. Yeah. So a couple of things we didn't talk about, but we wanted to make sure that we could get through this is we wanted to make sure that we could explain it all. But another thing, sorry, I just saw your note, Caroline,
It's all
about
good. It worked.
okay, cool. How old is the roof? When does the
Mhm.
AC need replacing? How old is the water heater? Those are also things that you're going to take stake on during your due diligence, but don't get into analysis paralysis. Right now, I would lock this baby up
Yep.
and then I would go do that due diligence. Why? Because let's say there's something really dramatic about that property, then we would trade down. What does trade down mean? I would tell the seller, like, hey, I would really love to give you $40,000, but it sounds to me like you're giving me a $10,000 bill on top of all of this because I got to go change that AC. So, how about I go change that AC and give you $30,000 instead? So, that would be an example of me trading down where I'd still be within the confines of what I've just underwritten because it's still a good deal. And honestly, sometimes I even show my sellers this like, hey, this is exactly what I'm not trying to take advantage of anybody. I'm not trying to make up things from like thin air. These are my numbers. And so I love to show this to sellers. And I absolutely love to show this to private money lenders so that they can trust in me when they're investing with me. So there you have it.
This was awesome. Thanks for doing this with us, Ingrid.
Thanks for participating, giving some great value. Again, if you haven't already, please follow the Caroline Kane on Instagram and YouTube, Mindset Marlon on Instagram or YouTube, and follow me on Instagram or YouTube using Ingryd Hernandez.
All right. Marlon, I appreciate the storytelling. Guys, if you need to, if you want to get better at sales, you need to reach out to Marlon because he's so good at this. Ingryd, you're awesome. Can't wait to get this under contract. I'm going to call the caller lead for this right after this. So thank you, everybody. Marlon, anything you want to say before we wrap up?
No, we're all good. Just appreciate everybody for coming out. If you had fun, make sure that you like, subscribe, do all that stuff right now, please, because this is how we grow the YouTube channel. This is, we're not charging anything for this. However, I do want to see this channel continue to grow. I want to see Ingryd's channel grow. I want to see Caroline's channel grow. If you're getting value, what's going to happen is as you like this, as you subscribe, as you turn on the notification, the algorithms are going to start to see other people who are similar to you, who are similar to us, who are going to get value from this, and it's going to put it on their feed. Think about how grateful you were when you first came across information that was so helpful and it just magically popped up on your feed. Well, it's not magical. It's an algorithm. So help the algorithm. Do us a favor. Click subscribe, click like, and we'll see you for the next video.
Sounds good. And if you guys would like to see anything from us, please let us know in the comments. That would be great. We will provide value where you're asking for. I wish I had an Ingryd and a Marlon in my back pocket when I got started. So thank you, everybody. Have a great weekend and happy holidays.